Good afternoon. 7 minutes after 4 o'clock, you're tuned to Money Radio. Name of the program, Financial Review. My name's Sinclair. No, the doctor is in. We are getting you up to date on the markets. We're finding out what's been going on in the economy, trying to make some sense of it all. But I can see it makes no sense at all. Today is Thursday, March 1st, 2012. Only day like it ever. What happened to yesterday? Wasn't yesterday supposed to be March 1st? It's like we got an extra day. Toss one in. 29 for the price of 28. Coming up today, we will, as I say, cover the markets. Then a little bit later, we'll be talking with Jay Taylor. Jay Taylor is the editor of Jay Taylor's Gold, Energy, and Technology Stocks newsletter. He also has a website called miningstocks.com and knows his stuff when it comes to mining stocks and a bunch of other little areas as well. He'll be one of the featured speakers, by the way, at the Wealth Protection Conference. That's coming up April 27th and 28th in Tempe. And if you'd like more information on that, you can go to buysilvernow.com. That's our good friends over at Resource Consultants. All right, let's get down to business. Taking a look at Wall Street. Dow Industrial Average up 28 at 12,980. S&P 500 up 8 at 1,374. NASDAQ Composite up 22 at 2,988. This close to 3,000 now. 10-year yield up 6 basis points at 2.04%. Oil up $1.53 at 108.60. And the metals moved higher. How about that? Because that was the big question lingering from yesterday. What happened to gold? And there probably isn't a good answer. The first temptation is to blame Fed Chairman Bernanke. But come on, think about it. If you own gold, really, we should all be thanking Bernanke. I mean, no one has done more to push the price of gold higher over the past few years than Helicopter Ben. Anyway, here's the thinking. Quantitative easing, or QE, and then the sequel, QE2, and then the next sequel, Operation Twist, which was swapping around short-term bonds for long-term bonds. These are all just different names for printing money out of thin air, and that is generally bullish for gold prices. So, yesterday, Bernanke is talking to Congress, and he acts like there isn't going to be a QE3, even though we know the Fed is buying mortgage-backed securities. Even though the ECB is throwing currency out of helicopters over in Europe. Remember yesterday, the ECB handed out 530 billion euro in long-term refinance operation, the LTRO. So even though it isn't officially QE3, there is still $700 billion worth of money injected into the global financial system. And that was just yesterday. And that wasn't enough to satisfy the wags, and they go running for the exits, and that triggers sell orders, and the next thing you know, gold is down 4%, which, keep in mind, in the grand scheme of things, 4% is not much, so stay calm. Pay attention, but stay calm. If we see some consolidation and a slow but steady retrenchment of the position, all's well. Remember, gold prices had been moving higher at a pretty fast clip, up 10% year to date, 10% in 2 months. That was heading into Bernanke's testimony yesterday, and then following the drop, we have seen prices inching back, indicating that investors used the dip as an excuse to get back into gold. I can't see that the move yesterday did any psychological damage. The trend is in place. Never before have the world's central banks sent so much money sloshing through the global financial system. From cutting interest rates and buying government debt to dangling cheap loans to banks and taking on their risky assets, the central banks have taken extraordinary steps since the 2008 financial crisis to nurse the international banking system back to health. Over the past 3.5 years now, the central banks of the United States, Britain, Japan, the other countries that use the euro, the 17 other countries over in euro, have pumped out so much money that their balance sheets have reached a combined $8.7 trillion. $8.7 trillion. That's a record, by far. The infusion of money has eased borrowing cost and raised confidence in banks and governments and companies, and central banks are separate banking facilities and responsible for various elements of their country's economies, but we are now seeing that monetary policy is being coordinated worldwide. In Europe, the central bank is pursuing a policy similar to the Fed's. The Bank of England is also using the Fed playbook. Earlier this month, the Bank of Japan strengthened its asset purchase program. Everyone is following the Federal Reserve's example of printing money to get out of this economic slump. Of course, injecting so much capital into the financial system devalues the money already there. This is a process that we refer to as inflation, and it leads to price inflation, and we are seeing some signs. And in the U.S., there are estimates that the real rate of price inflation is around 9% now. Meanwhile, in Europe, the fiscal response is a demand of more austerity, and the counterbalance to austerity is more monetary stimulus. At least that's the Eurobank's preferred counterbalance. They love it. And so every now and then, with this threat of inflation hovering in the background, every now and then, it is necessary for the Fed chairman to talk down the risk-on inflationary aspects of all this money printing. And so lately, we've been hearing Bernanke talking about the improving economy and the possibility the Fed would soon tighten credit and stop the printing press. It almost sounds a little crazy to even suggest the Fed will stop injecting liquidity into the financial system. I really don't think the central bankers have a tool in their tool belt for draining money out of the system. And if they tried, the result would be deflationary, and if they drained money aggressively, the result would be global depression, a severe global depression. That's the only possible exit from all this stimulus. There is no other exit plan. And so for now, the central bankers around the world try to control the inflationary aspects of stimulus, and one way is jawboning. Talking down the markets, diminishing expectations. Yeah, I know. The next question you're probably asking right now is, why is the stock market continuing to move higher and higher? If the Fed is jawboning that they won't be injecting liquidity into the market, why are stocks still moving higher? Well, we found that out today. Bloomberg is reporting the Bank of Israel is investing in U.S. stocks, and so is the Swiss National Bank. Yeah, I'm serious. The Federal Reserve is not supposed to invest directly into stocks, but see, they can give money to other central banks around the world that can. Yeah? Like I say, it's a coordinated world of central banks now. Let's turn our attention back to Europe and particularly the Greek situation. Today, the International Swaps and Derivatives Association made the proclamation that Greek debt did not default and credit default swaps will not be forced to pay for losses on Greek debt held by the European Central Bank. The ECB wants to avoid losses on its own Greek debt, and they're leaving private investors with a 70% haircut, possibly a little more. So the question today was whether this constitutes the type of subordination for non-ECB bondholders that would prompt a payout of Greek credit default swaps. Subordination describes the process of relegating a creditor's claim below that of others. Greece's debt restructuring deal is voluntary, but Athens has already approved a law with so-called collective action clauses, or CACs, which, if they needed it, it would allow them to oppose the same conditions on all bondholders, willing or not. Essentially, this means that next week we'll find out whether the ISDA considers the Greek default a credit event that will pay off for people who bought CDS insurance. What it's looking like is that the people who wrote the credit default swaps were in the premium collection business and not in the claims payment business, which is to say they were acting like insurance companies. In the financial crisis of 2008, the banks feared that their trading partners might not be able to meet their obligations on derivatives and other financial arrangements, and that situation set off a chain reaction, and that paralyzed global markets until the governments and central banks provided some enormous financial support. To prevent a similar disaster from happening again, finance ministers in the U.S. and Europe committed in 2009 to move derivatives like credit default swaps into clearinghouses. Those organizations, if they work properly, should be able to sharply reduce the chances that a large bank will not make good on such contracts. So the idea that CDS won't have to pay may seem like a calming event for the market, but the bigger question is, can the market work and function without the risk-controlling safety net of CDS? Because if there is no payout, what's the point? You're really not controlling risk. The big question is whether this is going to kill the CDS market, and if it does, well, it might actually be a good thing. I mean, at least then we don't have to worry about the side bets crashing the financial system, right? That's right.